Hello, I'm Mark Lowerty. Question: what looks like unit trusts but trades like stocks? The answer? Exchange-traded funds. Now, in this series, we'll look at 4 parts: what they are and how they work, the role they play in your portfolio, the risks involved, and of course, how to get started. Let's now start with something you might already be familiar with: unit trusts. They're also called mutual funds, and they allow investors to do 2 things they couldn't do individually. First, by pooling your funds with those of other investors, you can gain exposure to assets more efficiently, or you can invest in assets you don't normally get exposure to. For example, markets abroad, hard to access emerging markets, or even commodities. Or it might simply be unaffordable for you to buy a meaningful number of those securities. And second, your money is invested in different securities or markets. This also means your risk is spread across a potentially large number of securities. In other words, your eggs are in many baskets. This is called diversification. Even if one of these securities falls, or worse still, becomes worthless, you won't lose your entire investment. The index is simply rebalanced, and the fund manager will rebalance the fund accordingly. So that's what funds in general are about. Exchange-traded funds have the same advantages as unit trusts, but there are also some important differences. First, as their name suggests, exchange-traded funds trade on an exchange. Unlike unit trusts, you can check the value of your investment at any time of the day, as traded prices are readily available on the SGX website and brokers' online trading platforms. You don't get this level of transparency with unit trusts, where you only find out the price at the end of the day. Also, you can buy and sell ETFs during market hours through your stockbroker. You don't have to fill in any forms or wait until the end of the day. Market makers ensure there is always someone to sell you units in the ETF when you want to buy them, and to buy your units when you want to sell them. The second and arguably most important feature of exchange-traded funds is that they are passively managed. This means they simply track an underlying index. For example, the SPDR STI ETF follows the moves of the Straits Times Index. The SPDR Gold shares track the gold price. The LIX or MSCI Asia Pacific ex-Japan ETF gives you direct exposure to the Morgan Stanley Capital International Asia Pacific ex-Japan Index. There's no fund manager actively researching securities and picking which ones to buy and sell. ETFs are purely there to give you exposure to an index, not to outperform it. This saves you money, gives you peace of mind, and still provides you with diversification. As a result of being passively managed, the fees are also much lower. In industry jargon, they call this capital efficiency. Unlike unit trusts, there is no upfront sales fee. You only pay your stockbroker the usual commission and clearing fees, just as if you were buying or selling stocks. There is no stamp duty payable on ETF trades. Also, ETFs have a much lower annual management fee. The annual management fee simply pays the fund manager for managing the fund, as well as administrative costs and a royalty to the provider of the index which the ETF tracks. In the next episode, we'll hear from Frank Henze from State Street Global Advisors about how you can use ETFs in your portfolio, and I think you'll be surprised by some of their uses. Click on the links nearby the screen to get started by opening a CDP account, finding a broker, or signing up for courses and seminars through the SGX Academy.